Good day everyone, and welcome back to Quest for Alpha. In my last video I walked you through my approaches to the financial markets and I discussed two sides which defined my edge. All of this was shared so that you can see how simple trading can be, even if you are a parent, you pursue a career in corporate, or have a family to take care, or you're just simply a busy individual and doesn't have enough time to spend searching, analyzing the markets. Today I'd like to share exactly what I meant when I talked about the two filters. What I do in my trading is I follow multiple time frames to perform my analysis and to make a decision. I first start with a monthly time chart, so I look for a trend. I want to make sure that it's in an uptrend, and then I wait for a pullback to happen. So the price is pulling back to a specific zone which I call the demand zone. This is my second filter. Once the price is in this demand zone while in an uptrend, I go down a time frame, I go to the daily chart and I wait for a confirmation. This is the topic that I'd like to cover today. The execution, this is something that's very personal. It will not be shared in this video, but I will be sharing it in future videos. So let's start and take a look at the monthly chart. This is the hard time frame again, and it is the first filter. We always want to buy in an uptrend. So how's the trend typically defined? Usually what you have is price action that moves higher, and it forms higher highs and then higher lows. So higher lows and higher highs. At some point, this trend is going to reverse. And it reverses in such a way that lower lows and lower highs are going to be formed. Now, while this is super easy to follow on a schematic like the one shown on this slide, it is rather difficult and sometimes it can be pretty cumbersome when you see it on a live chart following the price action. In order to remove any sort of discretion and subjective approach. So how do I identify a trend? I identify an uptrend or a downtrend or a sideways market using an indicator. I use the exponential moving averages, the 10, the 100, and the 200. My rules are pretty simple. For the uptrend, I want to make sure that the 10 EMA is above the 100 EMA and the 100 EMA is above the 200 EMA. The rule for the downtrend is just the opposite. The 10 EMA needs to be lower than the 100 EMA and the 100 EMA needs to be lower than the 200 EMA. For the sideways market, it is simply when the EMAs cross each other. So let's take a look at a few examples. We will start going from the left image on the slide all the way to the right. For a downtrend, as I mentioned previously, we are looking for the EMAs to go in the inverse direction. So 200 is at the highest point, then it's 100, and then below that is a 10. Sideways market is when you have the 200 between the 100 and the 10. And for an uptrend, this is what we typically look for. We look for the 10 to be above the 100 and the 100 to be above the 200. If you have these conditions met, then you can comfortably say that you are in an uptrend. Well, at least this is what I do. Now that was the first filter. The second filter is waiting for the price to pull back to a specific zone, which I call the demand zone. The demand zones are also marked on the monthly time frame. This is on the higher time frame. The zone is valid if the following two things are achieved. So if you see a pretty explosive move where you have consecutive bullish, strong bullish candles being formed, that can generally mean that a zone has been formed, but that needs to be validated by making sure that a previous higher high or a previous peak has already been taken out. If you have strong consecutive bullish candles and you have removed or you have surpassed a previous high, then you can claim that the zone is valid. The way you mark the zone is you mark the last bearish candle before the impulsive move had formed. Now I will show a few examples of a good zone and some examples of zones that I would not consider to be valid. But first, let's take a look at an illustration of the demand zone. Right over here, we can see a pretty explosive move, strong bullish candles being formed. What we also see is that a previous peak has already been taken out by this specific move. The last bearish candle, which is this one, before the explosive move, is used to mark the zone. What we do is we wait for the price to come back to that zone. And as you can see in this example, the price just bounced off and went into an uptrend. Now let us look at a few demand zone examples. The top three are good and examples that actually worked out. In the bottom three images show some moves, some zones that I do not consider to be acceptable. Let's start with the image on the left. We can see an explosive move, two very strong bullish candles being formed. A previous peak has been taken out. The zone is marked by the last bearish candle. We can see that the price had come back to the zone and bounced off in the upward direction. The second example, we can see something similar. We can see pretty strong bullish candles being formed. We can also see that previous peaks have already been taken out. And then the zone is marked by the last bearish candle. Now you can see that I've also taken account the wick of the first bullish candle that was formed here. And that's just my rule. I want to be consistent, so I make sure that I take everything below the bearish candle that may form, such as in this specific example. As we can see, the price tried to bounce off. It didn't go too far. It came a little deeper into the level and then exploded into the upward direction. The third example here shows another strong move. We can see that this specific bullish move actually took a previous high, which is marked over here by the yellow arrow, and then the zone was defined by the less bearish candle. We can also see how the price came back to the zone and then bounced off. Now if we go down to the bottom left corner, we can see a zone that was formed that I do not find to be a good one or an acceptable one. This is because while there was a momentum and a very strong move upward, there was no previous high, previous peak that was taken out. So yes, this zone did work out, but it wasn't something that I would have considered. Now you can see here that there was a move that happened, many bullish candles being formed. Previous peak has been taken out, but if you see the candles, they're not very strong. There is a lot of wicks on these specific candles. So this to me was not an acceptable zone, and you can see that it actually failed afterwards. Then there was another similar move here. Previous peak was taken out, but the candles to me not very strong. A lot of wicks. A lot of these candles were defined by pretty strong wicks on either direction, and for me would not have been a valid zone you can see the price actually failed. Now, even if the zone is very good, not always would the zones hold. Oftentimes the price action will invalidate the zone. That is why we want to increase the probabilities, and we want to wait for a confirmation to happen. This is why we go down to the daily chart, which is the lower time frame. In the daily chart, we're looking for a confirmation followed by an execution. So how do we do that? Once a trend is established and a demand zone is marked, which is what we just covered on the monthly time frame, what we do is we wait for the price to reach the zone. We then move to a lower time frame on the daily chart, and we wait for a consolidation and then a breakout out of the consolidation. Once that happens, and once the price is above the 200 EMA, we can execute on the trade. Let's take a look at some examples here. This first chart shows an acceptable or a valid demand zone. I actually showed it in the previous examples. This is the zone, this is the explosive move. We're waiting for the price to come back. We saw that the price came back here, it bounced off a little bit, it went a little deeper, and then it bounced off with a strong upward momentum. If we look at what happened in A and B, we can get a better understanding of how the confirmation formed. So let's take a look at setup A. As the price came down, reached the zone, what we want is we are waiting for some sort of consolidation to happen. Some of that consolidation happened in this region over here. The price was actually above the 200 EMA, which was one of our conditions. But the second condition, where we were waiting for the price to go above the consolidation, that never happened. The price actually broke down here and it went a little deeper into the zone. So now we're going to take a look at what happened at B. At B, the price came into the zone, tried to get above the 200, nothing really happened. And then it came in this region here where it established some sort of consolidation. At that point, what we're waiting for is the price to get above the 200 EMA and to break out of the demand zone. So that happened on this specific candle here. At that moment, one can execute a trade, and you can see that the price continued to rally upwards. Let's take a look at another example. Over here on the monthly time chart, we do have a pretty strong momentum upward. We had overcome a previous high, which defined a pretty good zone, which was established or marked by the last bear candle. And now we waited for the price to reach that zone and ideally to bounce off. But we wouldn't take this blindly. As we discussed, we are waiting for a confirmation. So we go down to the daily chart, and as soon as it gets to the zone, which was at this point over here, we are waiting for a consolidation. And you can see a consolidation being formed in this region. At that point, we wait for a breakout outside of that consolidation, confirming that the price is above the 200 EMA, which would happen on this specific candle here. At that point, one can execute on the trade, and this was actually a very nice setup. The price rallied up. And let's talk about the third example here, where we had multiple zones created. This was one zone that was generated by the strong bullish candles here that had overcome a previous high. That zone was formed by this red candle, bearish candle, before the rally. And then another zone below it, where we also had some pretty strong bullish candles, I would say, relative to the previous price action, that also overcame previous peak. So what we do here, we're waiting for the price to come into the zone, either this one or this one, and we wait for a confirmation. This confirmation needs to happen on the daily chart, which is shown here. Now, I have marked this as 3 different setups that existed, A, B, and C. So let's take a look at what happened at A. When the price reached the zone at A, which would be right over here on this specific candle, the price did come above the 200 EMA. It consolidated, but there was never breakout. It actually broke down. So now we wait for the setup in B. And what happened in setup B is there was another consolidation that happened here in this region. The price was above the 200 EMA. What we wanted to do was to wait for the price action to break out of this consolidation, which never actually happened. The price broke down again. And then what we are waiting for is the price to make another push upward to get to some sort of consolidation, which happened in this region over here. We wait for the price to go above the 200 EMA, which happened here on this candle. But because there was a lot of movement prior to this in this region, what I also wanted to make sure happened is take out a previous high, which was this one over here, which I would in that case rely on this candle over here. I did not count this as an acceptable candle. Instead, this was my confirmation that the price wants to go higher. Okay, so in summary, this is a pretty simple method, pretty simple strategy that one can follow. I understand that there are a few nuances, but don't worry, we are going to clarify all of those in the videos to come. There are really 4 steps that summarize this entire video. The first one is that we use the monthly time frame and the 3 EMAs to determine if the market is trending upward. We then, on the same time frame, wait for a pullback to a demand zone. And remember, the demand zone needs to meet the 2 criteria that we talked about. Once the price is in the zone, we move to a lower time frame, in our case the daily time frame. We wait for a confirmation, which is established by a consolidation in a price which needs to move above the consolidation while also being above the 200 EMA. Once all of these conditions are met, one can feel pretty comfortable executing a trade. Of course, this is at least what I do and what I wanted to share with all of you. With that, I'd like to thank you for your attention. I hope that this was something that you found beneficial and you learned something new. Going forward, I'll be sharing a trading view chart, and I'll go over trades that I'm looking for taking in the weeks to come or months to come, and then definitely review some of the setups that I have already taken in the previous weeks. Thank you again, and until next time.